Hey there, financial explorers. Ever wondered what makes a stock hard to borrow and what that could potentially mean for its future price action? Today, we're diving deep into a specific company that's been lighting up our hard to borrow screener, LABT Biotherapeutics Inc., trading under the ticker LABT. We're going to break down exactly why LABT is catching attention and what the mechanics of a potential short squeeze look like. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show LABT logo/chart. Let's get straight into LABT Biotherapeutics, or LABT. This is a microcap company in the vital healthcare and biotechnology sector, currently sporting a market capitalization of $5.02 million. LABT is a clinical stage biotech firm developing antimicrobial products specifically from their novel bisphosphocin class targeting a broad range of infections. Now for the recent price action, LABT saw a minus 2.23% change today. Looking back a bit further, it's down minus 3.52% over the last 5 days and a more significant minus 16.9% over the past 30 days. Volume-wise, today saw only 85,100 shares traded, a stark contrast to its 30-day average volume of 2,888,220 shares. This translates to a relative volume of CRX average, indicating a significant drop in trading activity recently. What is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? Show graphic. CTB explained it refers to the annual fee that short sellers must pay to borrow shares of a company, which they then sell, hoping to buy them back later at a lower price for a profit. This fee, known as the cost to borrow or CTB, is expressed as an annualized percentage. The higher this percentage, the more expensive it is to short the stock. Why does it matter? Because the very high CTB signals intense demand from short sellers who want to bet against the stock, but also a limited supply of shares available to borrow. When borrow fees climb significantly above 100% annually, it means short sellers are paying over 0.25% daily on their borrowed shares, making their short position extremely costly to maintain over time. Why this stock is hard to borrow right now. Highlight LABT CTB, 689.7%. This brings us to LABT. Our screener flagged LABT Biotherapeutics because its annualized cost to borrow fee is an astounding 689.7%. That's not a typo. This is an extremely high fee, signaling significant demand to short coupled with the scarcity of shares. While the exact number of shares currently available to borrow is unknown, LABT has an estimated float of just 1.8 million shares. A small float means that even a moderate amount of short interest can quickly consume the available shares, driving up the borrow fee. Our internal composite squeeze score, which factors in CTB level, borrower supply, float size, and price momentum, gives LABT a score of 40.6. This score suggests it has some of the underlying conditions for squeeze setup, though it's important to remember this is not a guarantee. Squeeze mechanics explained. Show animation, short squeeze process. So, how does a short squeeze happen? Imagine a scenario where a stock like LABT with its high cost to borrow starts to move up in price. As the price rises, short sellers begin to lose money on paper. If the upward movement is strong enough, some shorts may face margin calls from their brokers, forcing them to buy back shares to close their positions. This forced buying creates even more demand for the stock, driving the price up further, which then triggers more margin calls and more covering. It's a cascading effect, a feedback loop that can send the stock soaring in a short period. The incredibly high 689.7% CTB on LABT means short sellers are bleeding money every single day just to maintain their position, intensifying the pressure for them to cover if the price begins to climb. Dilution risk check. One crucial factor for any potential short squeeze thesis is dilution risk. Show text. No dilution risk found. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can often be done to raise capital, but it floods the market with new supply, typically depressing the share price and potentially negating any upward pressure from short covering. For LABT, we found no recent dilutive SEC filings like SMINUS1, SMINUS3, or 424B in the last 90 days. This means that, based on recent public filings, the immediate threat of new share issuance that could undermine a squeeze is not currently present. Recent reverse split watch. Show tax reverse split June 22 ND, 59 days AGO. Another critical piece of context for LABT is its recent reverse stock split. Liquid Index Biotherapeutics executed a 1-for-10 reverse stock split on June 22, which was 59 days ago. A reverse split reduces the number of outstanding shares, which in turn reduces the float and proportionally increases the share price. While it doesn't change the company's market capitalization, it often aims to bring the stock price above minimum listing requirements or make it more attractive to institutional investors. Historically, we've observed that many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market digests the new share structure. While LABT split was slightly beyond the typical 1-month window at 59 days ago, it's still a significant event that can impact its current and future price dynamics and liquidity. This pattern, however, is not a guarantee for any specific stock. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you keep an eye on with LABT? Despite the sky-high 689.7% cost to borrow and small 1.8 million share float, we currently see very low trading volume compared to its average. This low relative volume indicates a lack of immediate buying interest right now. For significant short squeeze to truly ignite, we typically need to see a substantial increase in trading volume, indicating renewed interest and buying pressure that could overwhelm short sellers. Watch for any sudden spikes in volume accompanied by positive price momentum. A sustained upward trend would be the catalyst needed to put serious pressure on those short sellers paying nearly 700% to maintain their bets against LABT. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have strong conviction in their bearish thesis and are willing to pay a premium to stay short. Show LABT chart with CTV overlay. In conclusion, Liquid Index Biotherapeutics presents a fascinating case study in the world of hard-to-borrow stocks. This microcap biotech, with its tiny 1.8 million share float and an eye-popping 689.7% cost to borrow, highlights the extreme cost short sellers can incur. With no recent dilution risk in the context of a recent reverse split, LABT certainly has the foundational elements for a potential squeeze scenario. However, current low volume and recent negative price action mean it's not actively squeezing right now. It's a prime example of a stock to watch purely for its underlying mechanics. If you found this breakdown of LABT and short squeeze dynamics helpful, please give this video a like, subscribe for more in-depth stock analysis, and let us know in the comments what other stocks you'd like us to analyze next. Thanks for watching.